All right. Good evening, everybody. Let's go ahead and get started. Want to welcome you guys here. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there. Just let me know that that is indeed working. Hope everybody's had a fantastic evening so far. Looking forward to our live trading today and our discussion, which will be great. And like I said, want to welcome everybody here. Want to give a shout out to those of you who are watching this in the recording on the website. Also want to say hello to our YouTube audience. Want to say hello to you guys too. And awesome, awesome. Okay, looks like we're up and running, good to go. Appreciate that. Giving me an answer there in the chat box. Looks like we're good to go. Um, this is going to be an awesome webinar, and I appreciate you guys taking the time to come and hang out with me live tonight, and even those that are watching the recording too. I know not everybody can make it to a live webinar in the evening, but we've got a lot of really good discussion and things prepared for tonight, which is going to be really great. So, what we're going to do is we're going to talk about the sentiment index. Okay, some of you know what this is, or maybe you're vaguely familiar with it, and some of you don't know what it is. So we're going to have to, we're going to make sure everyone knows what this is first, and then we're going to talk about how you can use it, the application of it in your trading, and how you can spot out really great trading opportunities. There are two specific ways to use the sentiment index. And so I want to clear up the two specific ways you're supposed to use this index, because I think some people think there's only one way to use it. There's technically two major strategies that you can pull from the sentiment index. And so we'll start with, I guess we'll discuss both of them tonight, which will be great. But the key strategy I want to point out tonight is when sentiment gets crowded. So it's a crowded market concept. We do this with the COT report, and we also do it with sentiment trading. So, and specifically, we're going to focus on the sentiment tonight, which I think will be great. If you have questions, feel free to hit those questions in the chat box, and I'll get to them as soon as I can. More than likely, I'll cover your question. If I don't, which I also more than likely there will be some stuff I miss. Please ask questions because I'm sure other people will have those questions too. So, but let's go ahead and get started. Before we jump into our content today, as always, I need to remind everyone about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your contract size is, and ultimately how that would affect your account if you're to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, perfect, guys. Let's go ahead and talk about what the sentiment index is. Let's actually just take a visual look at a couple of sentiment indexes. This is one with my FX book. I'm going to show you several. We actually have one on our website. We actually pull the data from my FX book. They're kind enough to share it with us, and so we added it to our site. This is kind of nice because they've got it a little bit. I think they have it displayed a little bit better than I do. I try the settings I've got don't let me display it like this. This is really nice. This actually shows way too many pairs though. I try to just focus on the top 28 major forex pairs. But let's talk about what the sentiment index is. So sentiment is a feeling in the market. Okay. And it's basically how people think that the market they feel the market's going a specific direction, or they think the market's going to go up, or they think it's going to go down, and they express that by taking a position. Okay. So for example, in this first option right here, when you hover over the sentiment index on myfxbook.com, it gives you a little window or a little description or profile of the currency pair. Okay. And so it's saying, hey, the sentiment right now on the euro dollar is that most people are short and they're thinking that the market's going down. And then 39% are long right now, and they think that the market is going to go up. And so there's a bias there. What's the bias? The bias is that people think that the market is going to be headed lower. Now, the key thing we need to take away quickly is how, like, obviously we're going over what this is, but how is this going to help you make money? Well, how this is going to help you make money is because there's a general understanding that we have to have about sentiment right away, and that is that most traders are not very good at trading. When people have a sentiment as a group or a crowd mentality, typically the crowd is more often wrong than they are right. Now, I don't want to say that it's 100% of the time, because retail traders, which are the participants in this sentiment right here, can be right from time to time. And we'll talk about the times when they actually get the market right. But first, I want to lay the groundwork and the general and the preface behind this that most traders are generally not very good at trading. I think that's understood. In fact, I think statistically speaking, in the Forex market, it's somewhere in the 90 percentile of traders that don't make money. Just long term, they just never find a way to be profitable. So it's a tough market. It's not easy at all. And that's expressed through the sentiment index. And I think part of it is because when traders trade, they often trade the same way. What are some ways retail traders, which is people like you and me, generally trade? Well, retail traders try to find the bottom of the market. They try to fade the top of the market, right? They trade, like Dale says right there, they trade by emotion, right? So like for example, if the market's going up and up and up and up, a lot of traders try to time the top, right? And that can be a difficult thing to do, trying to time the top. When the market's going down, a lot of traders will view that as a bargain because they're like, oh, this market's going down, they'll buy the bottom. How many people like look at the crypto market right now? Since October 6th, crypto has been in a bear market. Bitcoin has gone from $126,000 down into the 60,000. It may even tipped into the 50,000s. I'm not totally sure. But if you look at what they're doing, a lot of people, at least when I watch, the Facebook posts out there from most retail traders, they're saying things like, "Hey, buy the dip. This is a dip." And clearly not a dip because crypto's fallen 50% from its highs, right? That's a correction, that's a deleveraging. That's not a dip. A dip is, hey, 5% pullback. Hey, we got a discount today. 10% pullback, we got a discount. We're in the middle of a deleveraging right now. And unfortunately, a lot of traders are going to have to realize the hard way that, and they have realized the hard way that it's been a deleveraging. It's not a, and yes, there will be brighter days with crypto again, 100%. I'm not trying to say that there won't be. It's just interesting to see the crowd mentality. And that's what I'm trying to help everybody understand is that there's a crowd mentality that gets you in trouble, right? And so that's just one example of where you might see something like that. Okay. So like I said, and then what are some other retail things that traders do? So a lot of traders like to put their stop losses, and I'm guilty of this too. I do this a lot, and sometimes it will work in my favor if I get the market, if I get the direction right in a signal or in a trade opportunity. But a lot of traders will sometimes put their stop losses immediately above resistance or immediately below support. And statistically speaking, that's actually not a great way to trade because that's where liquidity is. The banks know that liquidity sits just behind support and just above resistance. And so when the banks are trying to fulfill a position or they're trying to create a big move in the market, often the market will go directly where the stop losses are just before a big reversal. And we're going to actually talk about that tonight. I'm going to show you some examples of where you might actually see that. I'll even show you an example of where that happened this week in a very, very clear sentiment setup. So those are some other things that sentiment or not sentiment rather, but retail traders are guilty of. But the good news is that you don't have to be there forever. You can actually use those general crowded market or retail trading concepts to your advantage now that you know that the retail trader does that and you can escape that. You don't have to be a victim of retail trading concepts. You can actually use that to help you make money and be on the right side of of trading. So, okay, so I think we've laid the groundwork with sentiment. So this is known as a contrarian indicator. So whenever you see, for example, with the euro, we've got 61% of retail traders who are short and 39% of traders who are long. In a general sense, you would want to buy the euro dollar because it's a contrarian indicator. I'm not telling you to buy the euro dollar right now. I haven't looked at it, and that's not enough information to just go ahead and buy the euro dollar. But in a general sense, that would be a good contrarian view. If we look at the next currency pair on here, well, this isn't a really great one because pound dollar is only 52.48. So let's look at another one. Here's the dollar yen. 60% of traders are long and 40% of traders are short. So again, in a general understanding, you would want to be a contrarian here and you would want to go against the retail trader, and which would be you would want to be on the short side and not go on the long side. So it's kind of like when you ever hear you might hear somebody say, take the road less traveled or choose the harder right, those kinds of things. You might hear those sayings often. It's kind of the same concept with sentiment, right? You don't want to do the thing that most people do, right? So I like this style of trading because it makes a lot of sense to me. because I understand that most people are not very good at trading. And so I'd like to be on the other side of what most people are doing. Now, here's one thing where that diverges, and that's what this webinar is about tonight. We're talking about crowded sentiment, and that's going to take us into the second way to trade sentiment. So this is where things get really confusing. So this is a very important part. There is a moment where it is time to go with the retail trader, and that is, I think, the part that confuses a lot of people, because I think people have this general understanding when I teach this webinar that it's like, oh, I should just go ahead and go against the retail trader. And that is true, generally speaking. But there is a time where that seems to change. Does anybody know when that changes? So the time when this changes is when retail traders get completely biased, like overwhelmingly biased. We're talking about 90 plus, 91 plus percent and above biased in a particular direction. So this, not this morning, but yesterday morning, I gave an example of this, the analogy that I give of this. So this is the best way I know how to explain this concept. So here it is. So if you've ever made like cookies with your mom growing up, there, you pull out a cookie sheet. After you're done making the cookies, you got to go wash the cookie sheet under the water, right? If you ever try to hold the hook cookie sheet directly underneath the water and the water starts filling in the cookie sheet, if you ever so slightly tilt the cookie sheet, the water will rush to the other side, right? And then if you tilt it the other way to compensate, all of a sudden the water will rush to the other side. So the financial markets work almost in the exact same way when it comes in terms of liquidity and capital. So when one thing starts to flip one way, everything seems to go that way all at once. And when everything starts to flip the other way, everything seems to switch that way very quickly. So if you ever like look at a market, we'll pull up a chart in just a second, and you're like, this was a very bullish market, and then out of nowhere, the market will just seem to drop, right? That's a concept that is actually this concept playing out very quickly. It's just everyone was bullish all at once, and it seems like the carpet just got taken out, right? Or if you see a market that's just perpetually going down, and then all of a sudden it will just like flip the other way, right? It's again, it's the same concept at play. Okay, so when is it good to go with the retail trader? Let me show you an example of this. So right now, in fact, let's do this. I'm going to pull up a chart instead. So this is a trade I took on Sunday. A lot of you guys know about this trade. It was a really, really, really successful trade opportunity. So when I took this trade, let's say on Sunday, the market was about right here. This was on the Swiss franc or franc yen, if you want to pull it up. This is on an hourly time frame. So I used this in our live trading calls this week. I was going over this as an example. This is a trade that I'm in currently, and I've mostly closed the vast majority of this position. I just have one final position left here. It's a short position. So retail was at 94% bias to the short side on Sunday. That's very, very high. And so I saw that and I was like, okay, we must be getting close to the top on the franc yen. Why would we be close to the top on the franc yen when most retail traders are short? And again, like we established earlier, we generally want to go against the retail trader. So why would we want to go with the retail trader? So again, what happens with the cookie sheet? Think about the cookie sheet example, right? When everything gets completely, tilted one way, the only other option is to tilt back. Okay. So so if you think about it, let's go back to the sentiment index. All of these currency pairs are all sum up to 100%. Okay, so like for example, USD yen, we have 40% long, 60% short. If you add those two together, it's 100%. Okay. If you pull up, here is pound yen. We have 41% short, 59% long. You sum those up together, it's a 100%. So nothing goes over 100%, right? The sum of the two, long and short, is 100%, right? So when something like Dale says gets close to 100% on one side, there's not much more it can go. It means that retail traders are fully invested. That means they're fully wrong. They've been totally fooled into buying a particular instrument or selling a particular instrument, and they've basically got to a breaking point where they're just really in trouble. Okay. When that happens, the banks know that your stop losses are nearby. Okay. So that's really important. All right. They know that liquidity is present because retail is involved. They know that, oh, okay, we've got traders at 91%, 92 and up. So they know that you're already present. Not necessarily you in particular. I'm talking about just us as retail traders, the random Joe out there, the millions of random Joes who are trading the markets. That's what I'm talking about, right? They know that retail's there, and so all they have to do now is just go out and finish them off with one final candlestick blow, basically, to go take out liquidity. And that's when you get that, big, huge move to the downside or to the upside. Just depends on the direction that retail is biased, right? So with the Frankie, and let's go back over here. Let me do a rewind to Sunday. This is where the market was when I took this trade. This is what it looked like. And at the time, retail was at 94% bias. Let's do a full screen so you guys can see this. Oh, you didn't notice the sniper entry. Well, Mohammed, I did have multiple trades, so I got to be honest about that, right? But that was my absolute best trade, and I kept it open. I took it on Sunday, and it's up over 500 pips right now. Yeah, pretty incredible. So this is Sunday right here, and this is where the market was. It was at 94% biased, and so I knew I was getting close. And I'm going to teach you guys in just a moment how close you are typically when you get to this level of biasness. If that's a word, I don't know. I don't even know if that's a word. We'll just call it a word, right? If you get to this level of biasness, then you know that the market's pretty close to making that reversal. Okay, so now we'll do a little fast forward here. I took the trade short. I actually faded into it a little bit, and then about right there was the top, and then it didn't last long. I think this thing just started collapsing quickly. So have you ever heard the term bulls take the stairs, bears take the elevator? How many of you have heard that before? Bulls take the stairs, bears take the elevator. Yeah, yeah. So that's basically this. This is the bulls taking the stairs. They're stair stepping up. Okay, so it's a long bleed for retail traders who are short. They're desperate to get out of this position, right? So and then when the market collapses, that's the bears at play, and they just take the elevator downstairs. I mean, this took several weeks for this to. I mean, this goes back to the beginning of January, back over here, and it took like a whole month and a half for this to get fully biased and fully ripe for this move to come down, right? So during this time, retail, I'm just guessing here, but I'm guessing retail was probably in the 70s short, 70% short, 75%, 80% short, maybe close to 90, but it took until here. I know this for a fact because I saw it on Sunday. It took until there to get to 94% short, right? And then I think just a day later, it got up to 96, and then that was the end. That was the highest it got, and then it fully fell apart. So this is when you don't want to go with retail traders at that point. Once the cookie sheet gets fully flipped, that's when you want to start going against them. And usually there's going to be one last run at liquidity before it falls back. And that's what I wanted to show you here. So remember how I was saying that the market will usually go grab everybody's stop loss? Let me ask you guys a question. Let's go back to Sunday right there. So that was here, let's go back. Let's just go forward two candles. If I can go two candles forward. I just wanted to illustrate that high from Sunday, if I can. It's not going to let me. Let's get out of replay mode. All right. All right. Here we go. Okay. Here, let me see if I can do it one more time. Let's put this right there. There we go. Okay. So this, again, like I was saying, this was Sunday right here. Where do you think? So imagine this. People have 96%. What do we say? 96 something percent. 94% of retail traders are short. Where do you think they put their stop losses? Where does the average trader put their stop loss if they're short? Right here. Let's say they got in, they think maybe they even got in like right there and they're thinking, "Oh, we did so good. We're doing so great. Like we're selling this and this is already coming down." Right? Where are they putting their stop loss? Just above that high, right? That's where I mean, the banks know that. Like everybody, anyone, any professional trader would know that. Like the average person's putting their stop loss just above that. So now, here, let's slow down this fast forward. Let's just do three candles at a time. Watch this come up and just go clean that. Clock it. It's going to clock that liquidity right there. Just clocked that liquidity. I think it goes a little bit higher, and that's it. Yeah, so that's it. So imagine you're short right there, and that's when the market got up to 96% right there, and then that was game over, right? So so one of the things I do is when I see in the sentiment index that we're at, 91, 92, 93, 94% biased in one direction, I'm looking for the obvious places where people put their stop losses, right? So when you come in here and you're like, oh, hey, I'm at 96% or I'm at 94% or whatever it is, above 91 is kind of where I start. That's when you want to go in there and be like, okay, the market's likely going to go to the obvious, stop loss location where a retail trader would put their stop loss. And then that's what's going to cause that tremendous move to the downside. So if you can find those, that's what's going to give you these crazy, crazy good RR ratios where you can then get in and my trade right here, I'm going to go ahead and leave this. Yeah, you can see that's my position. So this is one of the trades I still have open, but I literally sold right at the top right there. But you can actually see all my positions on here. All of these little red lines, those are all my positions that I got into. So I did fade into this one. It was a little bit of a riskier trade, but I felt good about it. And then like I said, I just have this one left. I did get out of most of my positions right here, as you can see, and then I got out of the rest of them right there. So this was just a like crazy, crazy awesome trade. So now the question is, what is next? Is there another opportunity? And I want to show you guys how to get into these. There's two ways you can get into these types of trades. Another thing I wanted to point out before we go through the illustration of how to take this trade and the two different methods on how you can do that is I just wanted to point out that these types of trade setups do take some time. Like I have been watching this one for a while, and on Sunday it finally felt good to me. I was like, "Oh, we're at 94%. We're really close to the top." And sure enough, within 24 hours later, the market started to pull back. I think I was only in drawdown for about 8 or 12 hours to begin the week. And then the rest of this week, I was in profit on this trade, right? So this one was really good timing, but I've had some of these that can take several days while you're waiting for the market to finish what it needs to do. And then, we see that big blow off top move. And not all of them are this big. This one in particular was really amazing. Some of them don't go as far as, this, like I think Dale asked me how many pips did this make. So this trade currently is up 456 pips right now. And at one point, it was up 598 pips yesterday. So in 3 days, this trade was up 600 pips in 3 days, which is just absurd, crazy, crazy awesome. But it can take some time, and I took a lot of my profits here. I was expecting to make about 250 to 300 pips per trade, and so that's why I closed most of mine. And then we ended up getting a surprise move where it went a little bit further, and that's where I closed out essentially the rest of the position. Okay, so let's go over the two different ways to do this. Now, let's also go over when to start looking at these. So if you go to my website, tradingwithsteve.com, under free tools, you can click on the sentiment index. So you can actually access this for free, or you can directly go find it on the myfxbook.com. The nice thing about mine is it actually has just the top 28 major Forex pairs, and it also includes gold, silver, and I believe oils in here too, and maybe even some of the indexes like NAS 100 and US 30. I don't see them. Maybe I don't. Okay, maybe it's just gold and silver. And then and like I said, the 28 major Forex pairs. Okay, so when you come in here, this is how you research and look for. It's a quick little scan. This is all you have to do. You just kind of go over each one and you're like, okay, do we have anything that's over 90%? Most of the time, you won't even have anything that's, or you might have a few that's over 90, but it's not, sometimes you might even have nothing. And so in those situations, you have to lay off because I would not do this with something that's 85% biased. I probably wouldn't even do it with something that's 88 or 89. I truly wait for the markets to get ultra biased, like I said, 91% and beyond, and preferably beyond, right? Because the higher you can get, the better. The highest I've ever seen is 97% biased. I've never seen a major Forex pair go above 97. I've seen some exotic currency pairs get up into like the 99th percentile, 98, which I don't trade those. But if we're just talking about the 28 major Forex pairs, the highest I've ever seen is 97%. And it was like once or twice I saw that. And it was just, for a brief moment and then it was over. So like I said, I don't even know if you'll ever get that high. It'd be, if you've ever find that, let me know because that would be extremely rare. So you just kind of comb through here and you look at, okay, well, what's biased through here? Okay, we got Aussie dollar at 89% today. This one was actually at 92 yesterday, but Aussie dollar pulled back today, which is kind of what you would expect at some point. I thought it was going to go up a little higher first, but it ended up going back right away. So at that point, I probably wouldn't use Aussie dollar until it goes back up again. Let's see. We do have the Euro franc right now. It's at 92% and with a 7% short bias. So that one's definitely right up there. That's a candidate. What's another candidate? Well, we couldn't use Euro pound. That's close to 50-50. Euro Kiwi is almost exactly 50-50. Can't really use that. Can't really use this one. Here's pound franc. Like the Euro franc, we got a 92% bias and a 7%. That's a candidate. So we got two candidates so far. We keep looking through here and we're like, okay, I can't find any more so far. It's quick. You just keep looking through, check in to see if there's anything above that. Like I said, 91% is usually where I'll give it a look. I'll at least look at it if it's above 91. And that's it. Those are the only two. So that's pretty common to not have too many at a time. And that's good because we want to be very selective with the currency pairs that we trade this on. Because again, if it's not in that high percentage, I usually want to use the sentiment index as a contrarian indicator, and I'd rather actually go against retail and trade against them. So we really only have two candidates right now where we might want to consider going with retail and looking for those liquidity zones that the banks might target, like those stop loss areas. So let's go look at the euro franc and the pound franc. I actually looked at the pound franc earlier today, and I think it does have some options coming up soon. So we know currently that this is the most biased major forex pair in the market. This one and the euro franc, they're both exactly the same. So when we look at this, why and so let's actually answer this question. How did retail traders get themselves into this position? And the answer is almost always just a big move to the downside. If they're this long right now, it means the market's been going down probably on an hourly time frame for several weeks, probably even a couple of months. Okay? So a good time frame to use, I didn't answer this earlier, but maybe it was just implied, but an hourly chart is usually really good. A 4 hour time frame would also work well. You could use a 15-minute chart as long as you compressed it, but the 1 minute charts, the 5 minute charts are probably not going to be very good for this type of trading. And also, the daily charts can be useful. There actually is a use case for the daily charts when you're looking for liquidity, okay? And you're looking for those stop loss hunts that the market does and that the market makers do. And it is actually good to use those daily charts for that purpose, but just for generally analyzing the market, the hourly time frame will usually do just fine. Okay. All right, so let's look at this one. So what happened here? So since basically January 14th, this currency pair has just been on a tear to the downside. Every time it comes up, it goes down. It goes up, comes down. It just gets met with more and more selling pressure. So they're, like Mohammed says, they're pretty much getting crushed as usual. Okay. So how long does this last? Well, when they get to the 92, 91 percentile and beyond, Usually you're within a 1% move on major Forex pairs of a regime change. Okay. And that regime change could be just a major correction. It may not be that the pound franc could certainly keep going down in the coming months, but there's going to be a week like what happened with the franc yen where we get a complete regime change and the characteristic of the market goes from very bearish to ultra bullish, like get out of your way type of bullish like levels, okay? Just like like what happened with the franc yen this week, but that one was a bearish trade. We were bullish for, since the beginning of January, the market was just going up and up, slowly grinding. Bulls taking the stairs, bulls taking the stairs, and then immediately elevator, boom, bears come in and take everybody out, right? So that's what's going to happen with the pound franc at some point, but the other way around. Okay. So now that we know that this one's extremely biased, now we got to ask ourselves a question. If retail traders are buying, which we know that they are, 92% of them are biased to the long side, where would they put their stop losses on the pound franc? Well, now that you guys have seen this, you guys probably could answer that same question on this hourly chart. There's two probable areas where they put their stop loss. The most obvious one is below that apex low, right? That's the most obvious place where somebody's going to put their stop loss. So let me ask you guys a question. Do you think the banks are interested in this level just beneath this area? Oh yeah. Yeah, oh yeah, they're interested. They definitely want that area. That's one of their main targets right now because again, think about it. If retail traders are long and this market is going to have a huge move to the upside at some point, do you think the banks want retail long? No, they don't want them long anymore because they want your long position. So how are they going to get your long position out of you? They have to steal it from you. So how do they steal it from you? They have to forcibly take it by triggering your stop loss because a stop loss on a buy is the equivalent. It's effectively a sell, right? And the reverse is true with a short position. If you're short and you're selling the market and you're actively hoping the market goes down, if you close that short position, that's effectively a buy because in order to close a short, you have to buy. And in order to close a buy position, you have to sell. So they want you to sell below this low because if you sell below that low, that returns the long position back to their possession just in time for that major move to the upside. And the reason why we know that this will likely work on the pound franc and it's a good candidate for this is because retail is here. We know they're here because their involvement they're 92% long right now, right? So we know that they're here and they have stop losses actively in this area. So another good candidate, obviously this would be a good area too. I don't think that's the best area. I think the area that they're probably eyeing is just below this area. So that would be my interest. If I were trying to buy the pound franc right now, I would say somewhere in this zone is probably a good place to buy. Now, we got to talk about some logistics here about how far this can go because sometimes when the market gets this biased, it can be surprising how far the market can still go down before it comes back up. So a good rule of thumb is that there's going to be somewhere between a 0.5% and up to a 1% move still on major Forex pairs before the market starts to come back up. So what would that look like? From this current price, we know we're at 92% long. So the market will likely receive a huge move to the upside within a 0.5% to a 1% move to the downside. So what does that look like? Well, we'll just go ahead and measure the market on TradingView here. I'm going to use the measuring tool and I'm going to go down a 0.5%, which is right there. You can see it says 0.5. That would be 0.5%, which is pretty much where that line is, where we think the stop losses are. And then up to 1% move. So it could go as far as down here. I've seen it happen a few times where the market could go that far before you get your move to the upside. So one of these three outcomes is very likely. The market either goes up right away and we see a huge move coming in the next couple of days, or the market goes down to this, just below that apex low. Then we see the huge move to the upside, or the market will go down really far, about 1% from where it's currently at. and then you'll get that type of move to the upside. So this can be a challenging thing because as a retail trader, we're looking for structure to put stop losses. So there is a little bit of a challenge as far as like, okay, well, because I still got to manage risk, right? Like I got to have an idea of how far this thing's going to go, what kind of risk do I need to have involved. So I'm going to show you kind of how to walk through this, like how you should approach this, or at least how I approach this. And then if you want to adopt the same style, you can do that. I'm going to show you an aggressive way, a fading way to get in. When I say fading, that means you're scaling in as the market progresses. And I'm going to also show you a confirmation way where you basically wait for the market to completely change regimes and then you get in. And there's pros and cons to doing both methods. Okay. Um, I think the most surefire way to get in and get exposure is to do it through a fade and get in as the market starts to break down and you're just scaling in, but it is a more risky approach. Um, but it's a surefire way to get into the trade. You're not going to miss it if you do that. And then if you do the confirmation way where you wait for like a bullish engulfing candle and you wait for the market to finally hit everybody's stop loss and then you get in, that could work too. But and it's less drawdown, far less drawdown involved if you do it that way. But the challenge with it is you've got to be, you got to set alerts and make sure that you're there ready to go when that happens. Okay. So that's basically what we would expect is some move like this, either right away to the upside, a move about a 0.5% down and then up, or a move that could go all the way about a 1% move down to the downside and then up. So like I said, we're at 92% long right now. That could expand to 96%, 97% long by the time the market gets down to here, and then we could see that move to the upside. So retail is still very biased, like I said, but they could get even more biased. This could get silly before this gets better. Okay. And then, like I said, expect a pretty massive move to the upside. And one of the ways you can figure out how far this will move up is you can just go back on the hourly chart and measure how far these moves typically go up. Even like this move right here, you can measure that. You can measure this move. You can go back and find other similar base move to peak highs, and then you can use that kind of as a reference to get an idea of like how far this market will go up. And actually, I'll just move these over here to kind of get an idea, and we can just measure them manually and see like, okay, how far does this usually go up when it goes up? And it's like that is about 127 to 150 pips. So when this thing finally bottoms out, expect something like a little over 100 to 150 pip move to the upside. That's a general way to kind of figure out how far that might go. Usually I'm not in it for the whole, I'm not looking for a complete, you know, regime change that's going to last several months. I'm just after the swing trade that will last maybe for like a week, maybe 4 days. So once that 4 day move or week long move is over and we've essentially just rode that move with the market makers, you're pretty much done at that point. You can take your profits and move on to the next opportunity. So, okay, so let me show you how to do this the more aggressive way. So here's how I kind of approach this. So let me go ahead and delete everything. Here's how I approach this. So I've already established that this is a candidate. I draw a line where the current market price is. And then I got to realize that there's a potential for this market to go about 1% more against me before the major move to the upside. Okay. And then how far is that in pips? That's like 109 pips potentially that the market could draw down. Okay. These are swing trades. So if you're not used to this, this is going to blow your mind if you're a scalp trader because these are big pips we're talking about. But that's how you get these 500 pip type of moves. And I mean, you're going to have trades that make many hundreds of pips in a matter of days if you can capture this type of a move. But you got to be prepared for some pain as you kind of develop into the position. Okay. So I know I've got like 107 pips potentially for the market to go down against me. And so I got to keep that in mind. Now, here's what I also need to do. I need to figure out my max risk. So here's one way I would figure that out. Allocate a certain dollar amount to this trade. Say I'm willing to risk $100 on the entire position or $1,000. Or if you start to really get a big account, maybe you'll start to say, I'm willing to risk, $10,000 or $5,000 per trade opportunity. So whatever amount that is, you got to do the math on that. Let's just say it's $1,000. So I'm willing to risk $1,000 on the pound franc. And this is your capped risk. This is the most amount of money you could possibly lose. Okay, so you have to have those kind of parameters effectively in there beforehand. You have to kind of know, like, okay, I've got $1,000 potentially at risk. What is that going to be? So now what I'm going to do is I'm going to run over here to back to the website. This is now I'm in the process of taking the trade, right? I'm trying to make a prescription for myself as far as the lot size goes, trying to figure out how much this is going to be. So what I would do is I just go through each step one at a time. We know we're trading the pound franc in this example. So we type in the pound franc, we find, again, this is a free tool. Anybody can use this. You change your deposit currency to your local currency. For me, that's the US dollar. And then again, how many pips potentially could this market go against me um, before it gets better? Again, I measure a 1% move from the current price, assuming I've got something that's a candidate. Okay. So I don't just do it with any currency pair. If I have a candidate that's at 91% or more biased, either long or short, in this case, I got long. So I'm actually trying to go with retail traders, right? Because we're super biased. I'm going to measure that move from the current price 1%. And when I did that measurement, it came out pretty close. We're not exactly, but it's about 107 pips. Okay. So I've got 107 pips. I'm going to go over here, put in 107. I have an account balance, let's say, of $100,000. This actually doesn't matter as much because I'm going to show you what we're going to do here in just a second as far as allocating risk to this trade. And you have this you don't mess with. This is just how pips are calculated by the currency pair, so you don't mess with that. This is where you're going to change things. Now, you could do a percent risk on your account balance, or you can just change it to a dollar amount. I'm going to do a dollar amount in the drop down here. And I'm going to change the dollar amount to, like we said, we're going to risk $1,000. Okay. So, and again, you could risk maybe like if you had a smaller account and you're like, oh, I only have $25 to risk, or I only have $100 to work with, or something like that, then you'd have to do the math for that. But let's say I'm going to allocate $1,000 to this trade. And again, if you felt really good about the trade and if you've done this a million times and you're like, you know what, this is a 200K account I'm trading with, I'm going to risk $5,000. If that's what you want to do, you can certainly do that. Just this is something you have to be comfortable with if you were to lose, because you can lose. I don't want to make this sound like this is a surefire way. This is a great strategy. And a lot of you are going to do very well with this, and you're going to make a lot of money if you do this right. But that still doesn't negate the fact that we can get wrong and the market can get silly. There's also black swan events. There's things that can happen that are outside of your control. So you still must manage risk, but and obviously there's still great reward to be had. Obviously that's what we're trying to do. We're trying to make money, but we can't get silly. We're not trying to gamble right here. This is where you become a trading professional, where you go in and go through the process of managing risk. Okay. So we're going to put in for $1,000. Okay. Then we're going to go ahead and click calculate. And what this is going to do is it's going to say, hey, heads up here. If you're going to take a trade with 107 pips stop loss, okay, because that's how far we think the market could potentially go against us before it gets better, you have up to 0.71 or 0.72 contracts, which if you're using units, which I know TradingView uses units, you've got 71,930 units. That's what you have. Okay. So you could either just take one trade and allocate all your risk to just one position. And if this trade were to lose at 107 pips, that's it right there. You would lose, $1,000 on this trade. Now, here's the cool part. You get the opportunity to use this lot size however you want to use it. You can just do one trade, or you can separate it into multiple positions. What do I mean by that? So there is a benefit to scaling into this position because we have a pretty good idea that maybe the market may go one last time to the downside before a huge move to the upside, right? So if we're thinking that the banks might come down to here, we might want to try having a trade down there, right? Why put it all in at just one price? That's what a lot of retail traders do, and it's unfortunate because trading this way, where you kind of separate and scale in and dollar cost average into a position that you believe in, has a lot of benefits. And so, like I said, you could just try to get sniper with it and just put one trade down there and you're good. And you could put your entire lot size that you've allocated to this trade into that one trade, and that's fine. Or you can get into multiple positions. So what I like to do is I like to separate this into a total of 5 to 10 trades. So if this is my max lot size right here at 0.72 or 72,000 units basically. In fact, we can round it up. That's fine. We'll just round it to 72,000. I can divide that by 10. Okay, so let's do 72,000 and divide it by 10. And that basically gives me 7,200 units, which is basically a zero point zero 0.07 contract. So I could take 10 trades instead at zero point zero 0.07 contracts or 7,200 units. And what this is going to do, it's going to allow me to dollar cost average into a trade that I believe is going to be very successful rather than putting the entire lot size just in one single trade. This will help me get a better dollar cost averaged position than just, like I said, one single trade. I hope that makes sense. It's a little bit more complicated than just the simple buy here, sell here, done type of strategy. It's a little bit more complex. I get that. I'm going to show you an easier way, but this is the way I like to do it. And it's a tough thing for me to coach. It is a tough thing for me to coach because this is the way I like to trade. And most professionals that I know trade this way. And it's a hard thing to do because it's not as simple as like, here's your signal and buy here and sell there. And I'm not trying to diminish that type of trading because it is good. And there's a lot of ways you can trade really well that way. But at the same time, and it's also less complex, but at the same time, there's huge benefits to dollar cost average in your position, right? So, exactly. Like Mohammed says, better entries with more profits. Exactly. So, maybe the market does go up after it goes down. And if you're able to get a position down here and then the market goes up, that's going to help you become a lot more profitable and you're going to get a lot more pips behind that trade, a lot more real estate to capture. Okay. So, what I would do is I would say I'm going to divide that by 10 positions. Now, the other thing that you got to do is separation. You have to create separation between your trades. So if we have 107 pips and we divide that by 10, we have to separate the positions by 10.7 pips. And now you don't have to separate them by 10. Let's say you only took 5 trades. You could separate it into you could space that 107 pip range by 5. That would work too. I usually do 10 orders. Okay. So again, where am I getting this from? So again, if this is my position and I'm getting in right here to start and I'm going all the way down to this blue line, right? The distance between this blue line and that blue line is 107 pips, right? So if I want to dollar cost average 7 positions, or excuse me, 10 positions, I would take 107, which is the distance between here and here, right? Divided by 10. That means about every 11 pips or so, I need to have another position. So you'd basically come in here and you'd measure this and be like, okay, in fact, we may need to zoom in so we can see this better. We zoom in, and every 10 pips, you would just draw a line, or 11 pips rather, you draw a line, and that's where your next position is going to go. And then your next one. So you're scaling into a trade that we believe is going to be very successful up to the amount that we've allocated, right? Just like that. Okay. So every 10 pips you would do this. This takes more time. It's a little bit more complicated, but these trades are life changing, especially if you can capture trades that are down here just below this low. We don't know that though, because the market could easily just go up right away, and we want to make sure that we're at least in the trade and capture something if that happens, right? So we don't have enough time to go through each one of those, but that's how you would do that. And then you would go ahead and take each trade. You would go ahead and click buy, and then you would put in the positions. You could start with a market order entry. I don't use a take profit typically. I'll usually come out over the next couple of days after the trade takes off, and then I'll take my profits later. Usually these trades take somewhere between 3 and 5 days. I'm not really much of a take profit trader. I'm more of a time trader. If I think the trade's going to take about 3 days to 5 days to play out, I focus more on the time element of taking profit, not so much on did I get my price? Did I get the price I wanted? It's just more, okay, this trade usually takes 3 to 5 days. I'm going to close half my position in 3 days and another, the rest of it in 5 days or something like that. Okay. And then so you can just omit the take profit. You don't even need it. For the stop loss, though, you just basically put in not the average daily range, you put in that 1% move. So you measure from the current price and then you go down the 1%. We figured that was about 107 pips. And you would put a 107 pip take profit on each trade. Okay. That you choose to take. So let me kind of recap what we've done because this kind of can be confusing. So once you know what trade you're about to take and you've measured a 1% move from bottom to or top to bottom on a buy position, if it's a sell opportunity, you measure a 1% move. Then you head over to the lot size calculator, you put in that amount in pips, then you put in the risk amount which in dollars, and then that will give you a calculated total lot size that you can afford on this particular position. Then you divide it by the number of trades that you want to take. If you want to do it that way, you don't have to. You could literally just get in at market and put the entire position just on one single order. I don't like to do that, but you certainly can. So 1% of what? So Roger's asking me a question about this right here. So when you find a candidate, you measure 1% down on a buy. If it's a buy signal, you measure 1% down from the current price. And the reason why you're doing this, maybe I didn't explain that part very well, is because usually when you get something that's about around 91 to 96% biased, there could be up to a 1% move against you still before the major reversal comes online. Okay, you get it now. Perfect. I'm glad. Awesome. Because yeah, that is an important piece to understand. Yep. So if we go back to sentiment real quick, let's actually take a look. Let me pull this up. Let's go to the sentiment index. Pound franc, for the pound franc, we would measure a 1% move. For the euro franc, we'd measure a 1% move as well, right? And so you have to do it by pair. You can't just pick an arbitrary amount of pips. You have to go 1% on this one. If we actually did that on the euro franc, because this one's also a buy opportunity, we would go 1% down on this one, and 1% down on this one happens to be closer to 91 or 92 pips instead of the 107 that's associated with the pound franc. Right. So yeah, you're usually within a 1% move or less. Typically it's less of a major reversal that's coming online. And the other reason why you have to do it this way, guys, is because usually these currency pairs are usually if this gets that biased, it's usually you don't have support or resistance to work with. That's the thing. You're kind of you're on your own. You're on your own. And that's why I think that's one of the reasons why traders just focus on the long side and they kind of bury a hole for themselves is because they don't really know where to put their entries and stuff like that. So this is going to hopefully clear that up. Once traders get this biased, you're 1% away from a major reversal. That's all that's really important to know. Okay. Then it's just a matter of do you want to scale into 5 positions up to 1%? Do you want to just take one single position at market and see what happens? Again, I don't typically do that. Or do you want to scale into 10 different positions? And I like the 10 because it gives you a good separation and it helps you dollar cost average into the move that's about to take place. Okay. Now let me show you one last way to trade this. Okay. This is a little bit more difficult um, in terms of timing, but it's easier from a lot sizing and where to put in your take profit and your stop loss. Okay, so there are pros and cons to this. So it's easier in terms of like what to do, when to get in, but it's harder to make sure that you're at the computer when this happens because sometimes these moves can happen while you're sleeping, it can happen while you're at work. So if you don't fade into the trade while you're at work and have the trade ready to go, you're probably going to miss out on the opportunity. Let's go back to the franc yen because that's the big trade I took this week. So again, like I said, this move to the downside happened quickly. There wasn't much warning. Once this happened and decided it wanted to go down, it happened and it was over. And it happened before a lot of people could realize that it had happened. Basically, this week, the way it worked out for me is I took the trade here on Sunday and I essentially just woke up on Tuesday morning to a truckload of profits. But yeah, and that I didn't really have a warning. I didn't really have a warning. It just happened. And I mean, I knew it was going to happen at some point. I had a pretty good idea that it was going to happen. But unless you're at the computer, it's a tough thing to do. So what I typically do is I wait for the mark. If you want to do it this way, let me show you how to do this. Let's go delete everything. This was our candidate from Sunday on an hourly chart. I wait for it to make its first crack to the downside, like this one did. Then what you do is you wait for it to bounce back up to a liquidity zone. Now, in this process of finding liquidity, I just go back and try to find liquid, like this was obvious liquidity right here, like this zone. And you just throw a limit order in there, order to sell, stop loss right there. And then you can write it to the downside. So something like this would have been the trade you would have taken is you would have just gotten in at limit, sell, and then you would have waited for the market to absolutely just, I mean, this trade here, like this was a one to that's crazy. 1 to 13. Wow. Crazy trade opportunity on that move. But this is harder to get into because think about it, guys. This was one, two, three, four, five, six candles to the downside. And then it just had three candles to the up before it continued to back down. So this could happen while you're sleeping. And if you're not aware, or if you're not ready, you can miss out on that. So again, this is a tougher thing to do, but this is a much safer thing to do from terms of drawdown. Okay. Because if the market's wrong and or rather we're wrong about the market and we get triggered into this trade, uh, it's not too big of a deal because you're not going to lose so much in this opportunity. Another way is you can also use a higher time frame and wait for a bearish engulfing candle. So right here, this is a 4 hour chart. You wait on a 4 hour time frame and you wait for a bearish engulfing candle, which is this guy right here. Then you go ahead and get into the sell. If you do it this way and you wait for a bearish engulfing candle, which obviously that did engulf that green candle, that's going to get you in just in time. So that's the biggest pro is you're just avoiding you're basically avoiding all drawdown, which is awesome. Huge benefit to that. Downside though is that you're gonna have to basically you'd have to set your alarm and basically sit at the computer and wait for the bearish engulfing candle to form, and then you can go ahead and execute. So so if you've got the time to sit there and wait for that to show up on your chart, you can go ahead and do that. And again, I just don't think that's going to be practical for most folks, but it is the safest way to take the trade with minimal drawdown. So that's why I was saying, and like Dell says, scaling in is much better because you're guaranteed to take the trade. You are going to experience drawdown, but if you go through the lot size calculator and you figure out your max lot size and you allocate that across the dollar cost averaging, you'll be okay because even if all the trades lost on you, the worst thing that could happen is you lose the $1,000 that you allocated to the entire setup, which is not the end of the world because that's how much you allocated to the trade. Okay. So that's how I would go about doing that. Hopefully, we're crystal clear. We kind of ran out of time, but we're done pretty much. So I think we made good timing in this webinar. But that is sentiment right there. And that's my favorite way to trade sentiment is you're basically going in here and looking for crowded sentiment setups. Be patient. If you don't see an opportunity, wait for it to show up. Sometimes it takes a couple of days to get something in the 90th percentile and beyond. Once you see that, use that as a candidate. Go ahead and use the lot size calculator and set up your trade and have fun. If you guys have questions beyond this and you'd like to send me setups, you want some help, send me an email, steve at tradingwithsteve.com, and I will gladly take a look at your setup and help coach you along the way if you need any help. Happy to help that way. This recording will be up and we'll post it on the calendar pretty soon. I think this will also get on YouTube, so we'll make sure we get it there as well. But appreciate each one of you guys. Have a fantastic rest of your evening. I do have a COT report webinar we're going to do in about 5 minutes. Do a little 5-minute break. And we'll come back and then we'll wrap up the night. So appreciate you guys and we'll talk to you soon. Thanks.